Good morning. My name is Rick Myers, and I'm the president of the Thomas and Mack Development Group, and I would like to welcome you this morning to Insights from the Experts, a discussion on commercial real estate in Nevada. As you know, this industry impacts so many different businesses in so many different ways, and Nevada State Bank hopes you will find this information useful in your particular industry. I invite you to submit questions for our panelists via Twitter using the hashtag NSBWebinar. We'll make every effort to answer those questions during the broadcast. Joining me this morning are experts that are friends, colleagues, longtime business people in Nevada that we're going to have an interesting and lively discussion on this. I'd first like to welcome on the far left Doug Roberts, who's a partner with Panattoni Development. They do business in Reno, Las Vegas, around the country, Phoenix as well, and we'll have a lot of insight from a regional basis as well. I'd also like to welcome in the middle Mike Montandon, who's the managing director of Voit Real Services, full service commercial real estate brokers. They do property management, brokerage. Mike is a former mayor of the city of North Las Vegas, which was the fastest growing community in our country for many years. So he brings a wide range of insights to our discussion this morning. And finally, I'd like to welcome Hayim Mizrachi, a good friend and the managing director of NAI Global Las Vegas, a full-service commercial real estate brokerage company. These are the folks that are out doing deals in our industry, and I think we're going to bring some real insights to us this morning. Gentlemen, as we have this conversation, I think what's so important that we deal with every day and is important for people watching to be aware is the segmentation within the industry. That location is so important, that product type is so important, and even when you talk about size range, we have to make those distinctions. And a couple of the terms that we'll be using today that many of us use in our daily work, but I think to some might be different, is when we talk about product type, we're talking about retail versus office, office versus warehouse. We're also talking about multi-story office buildings versus single-story office buildings. We all know that those have a real impact on the things that we do and the decisions we make and where the availabilities are. So you'll hear some conversation relative to product type that I think is important. Another thing that you're going to be hearing that we all need to keep in mind is the lease structures. There's actually different lease structures for different product types or different situations. You'll hear the term triple net, you'll hear the term modified gross, and you'll hear the term full service gross. And I think it's extremely important to keep that in mind because when you say a rental rate's $2, does that include the operating expenses or does that not include the operating expenses? So we're going to talk a little bit about that, but just to begin the conversation, I wanted to make some differentiations as we talk about these things. The other thing is important to know where we're doing business. And Doug, you do business in Reno, Phoenix, Las Vegas. There's differences between those communities. Why don't you talk a little bit about some of the nuances and differences in those communities, because we have to make that distinction to have a good, positive conversation. Doug, what are the differences?
Sure. Even though Reno and Las Vegas are within the state of Nevada, there's vast differences in how the industrial markets, which I focus on, differ in both Reno, Northern Nevada, and Southern Nevada. And that, compared to Phoenix, is a whole nother difference. Even though the state enjoys a very attractive tax climate, I read yesterday that they're the third best tax climate in the country behind South Dakota and Wyoming. There's different reasons why people are in Northern Nevada versus Southern Nevada. Northern Nevada, you can find the 11 western states. Reno is right smack in the middle. It's actually more west than LA. So when you look at the geographic reasons why people are in LA, or Reno, is because of geographic diversity where they need to get their product. They don't want to be in California for a variety of reasons. Whereas Southern Nevada, you're here chiefly it's because of tourism, the gaming market. The population base here is 5 times what Reno is, and plus you're closer to Southern California. Whereas Phoenix really has enjoyed a better climate because what I consider the Nike swoop of industrial product movement from LA, Long Beach ports to Chicago via rail and the freeway interstate system. Phoenix is in the middle of that. Las Vegas is not.
Right.
And so therefore there's companies that go to Phoenix, not to Vegas, not to Reno. So even though Reno and Las Vegas are in the same state, very different reasons why someone would be up north versus in the south.
And I think that's an important distinction that we all deal with, that you're not necessarily competing Reno against Las Vegas or Las Vegas against Phoenix. People have made those decisions for other reasons. So the dynamics in those markets are different as well. Hayim, talk a little bit about once you're in Las Vegas, the community that we do our business, there's differences within the submarkets. North Las Vegas might be different from the airport. Talk a little bit about differences in submarkets within our community.
So those are two great submarkets that you mentioned, which we can draw a good contrast from. North Las Vegas and the airport submarket, particularly for industrial property, warehouses. Think about why somebody would want to be in North Las Vegas versus the airport. North Las Vegas has always been the lower cost alternative. Cheaper land, same construction cost equals cheaper rents for the end user. If you want to be by the airport, you're going to pay a premium for the location. You're closer to the airport. You're closer to your clients if they're on the strip. And sometimes that is a justifiable expense to pay when you're talking about fuel costs, driver times, deliveries, those types of things.
How wide can those, when you talk about differences in pricing, is it a penny or two, or are the margins wider than that?
No, on warehouses, they've become wider. I said North Las Vegas was a lower cost alternative. What happened when the economy had a downturn is that rates came down in the airport, so folks were saying, hey, I can be closer to my clients, closer to the airport, closer to all these things. I'm moving into the airport or the Southwest. So we're not talking about pennies. We're talking about 10 cents, 20 cents in some cases.
And 10 cents or 20 cents on a 100,000 square foot building or a 250,000 square foot building on a monthly basis is a huge difference. So we have to keep that in mind as we have this conversation. When somebody says, let's talk about commercial real estate, we want to say what product type, what location. Then we can have a good conversation about things. It's been an interesting time. It's been a trying time, but there seems to be some signs and some activity. It seems to me that deals are starting to happen and get going. Mike, are you seeing some activity, and is that activity actually translating into deals being completed?
Well, we are seeing some activity, and as I'm listening to both Doug and Hayim, you talk about the differentiators between Reno, Las Vegas, Phoenix. Then you talk about the differentiators between various submarkets right here in Vegas. And the same principles apply to differentiators between various buildings. Right in, and every client's different. And, we just put a fairly large tenant in place, and they had some unique needs. We can say that about every tenant, right? Nobody comes in and says, yeah, I'm textbook.
Right.
I need this. This tenant said, hey, we're 24 hours.
Right.
Well, that changes everything. They can't be in a building where the security locks down at 5 o'clock. They're going to be running shifts all through there. And we're going to put about 5 people per 1,000 square feet, so that's about how we're going to have to park this. And we don't really want to share a building, and we need access to this. We need this much fiber optic connectivity. So we throw 8 buildings out in front of them to look at, and really 6 of them are eliminated almost immediately. So it's very similar to what Doug was saying about Reno. Right. Somebody who's looking in Phoenix because they want to be part of the Nike swoop of industrial can't look in Reno.
Right.
And so this particular tenant came in, and it really didn't come down to price.
That's a really interesting comment, and ironically, involved in that particular transaction, we were somebody who was looking for that tenant as well. And while we had enough space, we had it in the wrong building type. We had it in a multi-story building that would have been shared with other tenants rather than a standalone building. So we have to keep these things in mind, that even though there's space out there, every tenant is different, every building's different, and because of the unique needs of the tenant, they picked a particular park, and it made a lot of sense. And so we can't just say because there's 2 million square feet of vacant space, that means there's deals to be had everywhere. It makes a big difference relative to where you're going. And I think that's also important, Mike. That was a pretty big deal. I mean, you're talking about a full building deal. You're talking about a large building. That's significant.
And they wanted to be in for at least 10 years. Mm-hmm. So, this is a decision they're not going to make lightly.
Right.
And so we are seeing there are still people out there looking.
Right.
And they're not as plentiful as they used to be.
Right.
But it's still exciting, and it brings to mind that all the principles of real estate still fall back to be the same in a good market or a bad market. Location is critical, design features, access, all of the things that we we're looking for in a great market, we're still looking for.
And that's important. That's a large brokerage transaction that helps the brokerage companies. There will be design fees involved in preparing the tenant improvements. General contractors are going to be involved in building the tenant improvements. That's good news that deals are happening. Hayim, talk a little bit about activity in various markets, what you're seeing happening from an activity perspective.
There's definitely activity. It's across the board. I'll tell you about a deal. I can't talk too much about it, but I'll give some pretty nice highlights. We took a 300,000 square foot office investment asset to market in July. We had 2 weeks worth of showings for buyers who were serious about buying a property like this, who have the money to buy a property like this. At the end of 2 weeks, we had 22 unique tours. We had 17 offers, 8 of which were above $28 million. The aggregate of the offers was about $400 million. There were 3 groups from Las Vegas, 1 from back east, and the rest from California. 3 were probably from northern, the rest from Southern California.
That's really exciting, and there's a few examples of portfolio and large transactions that are taking place that are really a dynamic in the market today. We all read about in Summerlin, a number of properties were sold to investors from California from a money perspective. That's important because it says that the investment community around the country is looking at Las Vegas as a viable place to do business. So, there's unique situations in your transaction and the other transaction, but I think that's very positive that a lot of offers came in on properties like that. So still lots of challenges, but that's certainly good activity. One of the other kind of unique transactions that's taking place out there is build-to-suits. And Doug, you've been involved in a number of these over the years. It's one of the things that Panattoni has done so well across the country, and I know you're working on some now. I think what's important for all these conversations is to not dwell on a particular building, as Hayim mentioned, or a particular transaction, but the concepts that come out of it. Talk a little bit about a build-to-suit. What is it? How do these come about? And where there are opportunities? Because they're large transactions. I think it's significant.
Yeah, it has been a forte of Panattoni, but frankly, it's not for the faint of heart. It can be a lot of work, very arduous, and in some ways, doing speculative development is so much easier because you control your own destiny. You determine how it's going to be built. Of course, that could be good and bad. If you don't build the right product at the right time, you could suffer the consequences. A build-to-suit is unique because it does allow you to have an end game that you know is knowable, if lack of better words, where you know that you have the tenant, you have the tenant's term set, you have the financial parameters already set for it. The problem becomes, and a lot of times, is you're always best to have the tenant in control and then go find the land, do the building. But that sounds simple, but it's not simple. Right. There's always, people fly into the valley and think, well, look at all this land. Well, there's always a reason why it's not being built on. There's utilities or zoning or topography or issues or environmental, whatever. But so it is a unique animal. Having said that, it's also a very fun transaction. I enjoy them a lot because it gives you a chance to understand somebody's business from the inside out. For the most part, I've worked with very pleasant people who are just trying to get work done, and they're very amenable and honest and just tell you what they want. In our case, in Las Vegas, we've done several of them, which both pure build-to-suits and spec-to-suits. A spec-to-suit is when you have a building designed, a tenant comes along before you start construction, you modify it for them and build the building. But in our case, I think to Hayim's point and understanding just it's not when he talks about the aggregate value of the offers, it shows you how much capital is out there trying to get placed. And for us, it's not the problem of getting capital, it's finding deals for that capital. And a build-to-suit, at least you go to a lender and say, I have a tenant, here's the building, it's going to be market-oriented, here's the location. And usually lenders are very apt to make a good deal on those type of buildings. Spec is a lot different animal just now because there's such an unknown in the marketplace, so build-to-suits can be unique in that regard.
Right. Talk about some of the unique characteristics of a build-to-suit, how it's different than a regular building, why they chose to go the build-to-suit route rather than just any building on the side of the road.
Well, probably the biggest reason why people do build-to-suit is because that very reason there's not a building that exists. And over the last 5 years, build-to-suits, even though you'd think it would be pretty prevalent, number one, the economy's been down, people don't want to commit. Right. But number two, there has been a pretty good supply of buildings on the market where somebody doesn't have to do a build-to-suit.
Right.
In Reno, for example, there's 2 buildings over 200,000 feet left. We just signed a 292,000 foot lease that took up our remaining inventory. So that's going to force people to do build-to-suits. But a lot of times there's some unique characteristic. We're going to do a build-to-suit for Shuffle Master or Shuffle Entertainment now, whereas they wanted a 130,000 foot building, but most of it's office. So 60% office space, that means it's unique parking requirements, something that's unusual you can't find in the marketplace. You're not going to find a 130,000 foot industrial building with enough parking for that kind of office space. Maybe there's a unique power requirement. Maybe there's a clear height requirement they don't have in the marketplace. So things like that are going to affect whether they go to build a suit or not.
Right. And I think that's important. That's a huge transaction. That's a lot of economic activity that shows that while a particular building isn't being leased up, there's going to be a large development that is taking place, and I think that's important. Mm-hmm. And Doug, I think you also touched on something, Mike, you probably have some comments about this as well, is capital. There's a lot of money that's out there, and I think that's really positive. This would be a completely different environment if there was no money to make things happen. There's money out there looking for opportunities.
We had a group come in, and I'll say this kind of jokingly because I was listening to what Hayim had to say about this. When a true institutional quality investment comes on the market, and I think we all share, there really aren't that many of those here in the Las Vegas
Describe
market.
the characteristics of a true institutional quality investment.
Something that you can project stabilized income, but probably the most important feature is over 10, maybe over $20 million. That's a big deal.
Right. So these large investors don't
large
want to come and
investors,
place a lot of $500,000.
They've got $1 billion they have to place. And in the words of one of the investors came and said, "We got money horny for a deal."
That's right.
They just said, "We just got a lot of money."
That's right.
And I don't have it takes just as much due diligence to put money into a $5 million deal. I'd rather waste all that time doing $25 million at a pop. So they're looking for the bigger deals.
This is a really interesting dynamic that's going to have benefit. There's huge money that's been raised that needs to be placed. It all started going to the core cities and the target markets of Los Angeles and New York and Boston. But that money needs to be placed somewhere. And now we're starting to see the impact of that they're looking at secondary markets.
It's why that Summerlin portfolio sold.
Absolutely. The money needed to be placed, and that's a benefit for all of us.
That was a asset. It didn't matter that it was in Vegas. That was a high-quality asset over $100 million. That was going to attract money no matter where it was at.
That's exactly right. That's one transaction to place $100 million rather than 10 transactions to place smaller, or 20 more importantly. You know, one of the interesting things to me in the market right now is, for talking purposes, to throw out a number, Hayim, 65% of the buildings in Las Vegas have changed hands. And statistically, we can talk about that number, but the dynamic is properties are changing, and that presents opportunities and different dynamics. And now we're seeing different people owning these buildings. Maybe buildings weren't in play and are being put in play. Talk about some of this change and how that's impacting you and transactions you're now able to pursue that you might not have been able to pursue before.
One of the changes is the reset in values. I have a broker in my office who has had a banner year this year working with first or second time investors because he has the patience to teach them how to get into this business as an investor. And he's coaching them on buying office buildings with maybe one tenant, like an 8,000 square foot office building with a 4,000 square foot decent tenant and a vacancy on the other 4,000 square feet, but they're buying it so low that they can compete with any other property in that market and get a tenant. And the returns that he's getting for his investors are pretty good.
Attractive.
I mean, they're very attractive.
Right. That's a really interesting point. If my basis in the building is $200 a foot, I have to rent it at a certain rental rate. If somebody buys that building at $100 a foot, they suddenly have a different ability to do a deal. So a building that was not able to get into play, to create a transaction, to create some construction work, is now being able to put into play. And I think we're seeing this.
You're describing the majority of the market in Vegas, and Hayim is too. We can all pull the reports, and it doesn't matter which economist you pull, it says there's no positive absorption. So the only absorption is to move tenants around.
Right.
And so we're the people who are able to reset. Hayim's new client,
right,
as a new investor, can find a client from somebody who wasn't able to reset their price yet.
Right, and there will be situations that are tough on some owners, but it means there's activity, and that's very important. And when some of these opportunities come up, not everybody can take advantage of them. Investors are different. Doug, you and I worked on a transaction where there was an opportunity, but because of your company and the fact that you have a development arm and a construction arm, you were able to do some things that maybe an individual investor wouldn't do. And just in general, talk about when you see opportunities and that one happened to work out well, but there was a moment in time we didn't know. So there's unique opportunities for unique investors.
Well, I think in some regards, what they're saying is absolutely true on resetting the values, and we've talked about this before. If a project's ill-conceived, it will never be a good time. If it was ill-timed, you're probably okay, where you can at least take that product that's a good, marketable, functional building and make it work. There's some stuff that should be bulldozed. I remember you said that 4 years ago.
That's a really important one that let's reiterate it, and I have said that a few times. Take 25% of the buildings that were built in the last 5 to 7 years and bulldoze them. Not literally, but you said that very well, that if they missed on the timing, that's one thing you can recover from it. If you missed on the actual building itself. And there are those dynamics that are out there, aren't there?
Well, yeah, I mean, I'm not the brightest guy in the world, but there's some products I walk up to and like, what were you thinking?
Right.
And it's a matter of, really, I think it's somewhat of the free flow of capital during the mid-2000s, where there was so much money available for either the lender side and the equity side. So things were built that shouldn't have been built. Couple that with the fact that there's really a product type that people built in the 2005, 6, 7, especially in Las Vegas, where it was affordable for a developer to go in and buy land at market rates, build a $5 to $10 million project, but mainly comprised of smaller buildings. And there was just a dearth of smaller buildings built, and some of them good, some of them bad, but there wasn't a market sense of what should be built because that's what they thought they should build. And so we had this, especially in North Las Vegas, unfortunately, just a plethora of small buildings for sale, for lease, that just shouldn't have been built in the first place. The market didn't require it.
Right. So the statistics that are in there about vacancies and such, there's a lot of buildings that sort of will not get absorbed, but it doesn't mean all building types are different. And as we talk about differences and we start talking about some of the deals that were done, I think there's a very important distinction we have to make. When we say banks, we have to understand that there's a very, very wide variety of banks. We're really not even talking about banks, we're talking about lenders, because it's such a broad perspective. And we have to be careful not say the banks do this or the banks do that. What an international bank like Deutsche Bank might consider doing versus a Wells Fargo versus a community bank, those are all very, very different. And I think it helps our conversation and it helps our community when we say we take every transaction for the uniqueness of it and not try to say why are the banks doing that and why did that bank do that. They all had given circumstances at that given time and they made those decisions. What we need to do is look at the unique attributes of each. Mike, any comment about this?
And I'll take what Doug had to say earlier. I loved his statement when he said the build-to-suit, which to a lot of people sounds like, just manna from heaven.
Right.
But he said it's not for the faint of heart. And he talked about a build-to-spec also. I'm going to translate that over into the office market. We watch these deals, and every deal is so different. Sometimes you're dealing with a very sophisticated building owner and a not so sophisticated tenant. Sometimes it's vice versa, a brand new investor and a really sophisticated tenant who knows what they're doing. And I've watched these. You threw out some terms in the beginning, full service gross, and I've watched these leases on just a few words completely turn around, and somebody walk in and offering a very substantial tenant improvement allowance. And the tenant somehow manages to convert that. Well, why don't you just go turnkey?
Right.
And this building owner saying, I was willing to put $50 a square foot into this, and I think I can do it for $30. If he wants to do with me turnkey, I could maybe save some money. And the next thing you know, it's like Doug said, it's not for the faint of heart. You end up at $80 a square. Everything changes because the deals are so unique, and the players
are different.
They're all at different levels.
Right. Well, you can build out space in Dallas, Texas for $30 a foot. That same space here in Las Vegas may be $50 a foot.
Absolutely.
So it's that changing of the basis and changing who the players are can have huge impacts on this. Now what happens on your economics when you thought you were only going to pay $50 and now you're going to pay $60 or $80?
Yeah, or occupancy date moves because a certificate of occupancy wasn't there, and you end up eating a lot more rent than you planned. There's
Right.
deals that really change the economics of those
Right.
deals.
And as we're going through this, there's clearly a theme here. Number one, that everything is so different. You need some guidance to go through it. And once you recognize the difference, it actually gives you a comfort to not get hung up on one particular transaction. It's all different. And number two, you need experts. And these guys watch it every day, they do it every day, and they see the consequences of it every day. So there's really good people out there to help us through this process. I think it's interesting. Hayim? Yeah.
You just touched on the point that I wanted to make. I think we're all a part of an association in town called NAIOP. And as Mike was talking, as you were talking, it reminded me of something that the president, Kyle Nagy, said at the last holiday function. He said, "Look around, we're not what's left of the industry, we're what's best in the industry." And with all of these distinctions, all of these unique factors you have to look at, building by building, submarket by submarket, lender from bank, it's important for the audience at home to know that there are really qualified experts. We do this every single day. If you're a doctor, be a doctor every day. Let us be a real estate advisor every day.
Right. There's no question. It's very interesting. You have to have seen it over time to see where some of these trends are. Where are we in this cycle, Doug? There was a period of time when there was a lot of properties that were changing hands, going through the lenders. Now remember, a lender could not only be the lender themselves, but they could be a servicer. It could be a court-appointed receiver. Mm-hmm. So nowadays you have this whole dynamic of who am I talking to? Mm-hmm. Am I talking to the owner? Will the owner remain the owner? Will suddenly I be talking to a loan servicer or someone at the bank? All these are dynamics. Where do you see we are in this cycle of transferring properties? Do you think there will be more properties that come to market? How do you see where we are in the cycle of things?
Yeah, I think, between Reno and here and Phoenix, Southern California to some degree, just because of those markets I'm most familiar with. But I think we're pretty much at the stabilization of ownership. I think the properties that have transferred in the last 3 to 4 years based on a variety of reasons are pretty much done on a wholesale level. I think there'll be individual transactions and things that will happen just because that's the nature of the real estate business. And as I told brokers 5 years ago, you just need deals to happen. Good, bad, negative, positive, doesn't matter. A transaction. For a developer, it could be quite negative. But you guys just need those transactions to happen to make your annual wage. So for me, I don't think that's going to happen on a wholesale level. I do think, based on what I'm seeing, I kind of think people chase yields from the outside in.
Yes.
And there's a smile across the United States where people focus their money and their energy, West Coast and the South, East Coast, and they start going inland. I think Las Vegas and Reno and Phoenix have already experienced that chase of yield where people want to put more money in the marketplace. And for me, if I own a building and I think my basis is positive, but I can realize a return pretty quickly on an IRR basis, I'm willing to do that. Carl Panattoni, my mentor, always said, if it's a good deal for you, it's a good deal. Don't worry about what the market thinks later or now or whatever. It doesn't matter.
Right.
So, but I do think the wholesale change of ownership is pretty much done.
Right. And I think that the Summerlin transaction is important where you're seeing the money coming in from the coast to some of these other markets. Mm-hmm. Mike, where are we in the cycle?
Well, I use the term bouncing off the bottom that we've been for a little while, but we're definitely not going any lower. Mm-hmm. I don't know how far up we've come and whether the recovery is in full swing, but we're at these points where, and you see it in the appraisals. I was an appraiser for a long time, and I go through these, and there was a time when any building that was 70% occupied, you just made an assumption that someday it would be 95% occupied, and you kind of worked up to when people are looking at portfolios at 50, 60, 70% occupied and buying them at a return on that as a stabilized, means we're not going any lower. We have nowhere to go but up from there. And again, we talked about kind of before the meeting some of these deals that are at so much below replacement cost that there's ways to make money off of it.
Yeah, and the people that have jumped into their credit have, and Doug certainly has looked at some distressed assets, put up the money, made a decision, took some risk, and made it paid off. So there are opportunities. I think that's definitely a theme for today, is that there are opportunities out there and people are doing things. Hayim, what's your sense of where we are in the cycle?
You use the term distressed property. We've been getting calls for the last 2.5, 3 years from people, and that's the first thing they say is, I want a distressed property. Well, tell me why you want a distressed property. Because I want a good deal. Well, what does good deal mean? And once you start digging down, peeling back the layers, you realize that today, as we're all sitting here talking today, there are deals on the market that are not necessarily distressed in that context. There are assets that are coming to market and are trading that are private to private seller, private owner, not a bank, not a lender. Our parent company is a special servicer.
Describe that.
So we all heard the term CMBS. You have all these loans that are pooled together and sold off. They are the entity that will service that loan. There might be 19 different owners for that loan that they have to report back to you or disseminate the funds to.
And this is important. This is, traditionally a bank makes a loan and they have the loan file and it sits in somebody's desk. Because of this whole securitization of loans, they package these, they sell them off. It's really a security now. It's like a stock. Well, there's no file anymore. Someone has to manage these things, and that's where the term servicer comes from. And there's a lot of them in town that are managing buildings. They are effectively the owner right now, are these servicers. The original borrower is now gone. So this is one of those many, quote, lenders that we talk about, but there's dynamics associated with it.
So our company got into the business and started acquiring more of the positions of the bonds to be able to be the special servicer. Now they control about $170 billion worth of assets that they service. They underwrote this business model at a 15 to 20% default rate. It's performing at a 35 to 40% default rate. They're projecting another 5 to 7 years of this ownership transfer, as you called it. I think it's more in line of 3 to 5 years. I think that things are moving a lot faster than they think they are.
And I think those are more national numbers that you're talking about, so that dynamic may be a little different than it is locally. But I think that's extremely important, is that maybe the community banks have processed their properties, but there's still servicers, there's still other lenders that have properties that are out there. But as these properties change, there are dynamics. Mike, your company's managing buildings that have gone through the change of ownership process. That's opportunity for you, your company, individuals.
And let me touch on that for just a minute. We actually got into the property management business a few years back. Bob Voit had originally gotten out of it and back in for that very aspect, the same reason that Hayim's company is associated with a special servicer, because they seem to have their fingers on more properties than the private owners did.
Right.
And the special servicers, by and large, they're not really in the business of owning, just like lenders, they really didn't intend to be in the business of owning buildings. And they're not really all that good at it.
This is very true and very important. They're stewards of a loan versus
they
property owners.
To manage a loan.
Right.
And foreclosing on the building was never the first line of defense.
Right.
It was always payment is what they wanted.
Right.
And so they own these, and so we got in the business, like a lot of people, of managing those things for receivers. And I have to share this, and you talk about trends. A little less than a year ago, I was looking at a portfolio of several million square feet that we were managing, but it was turning over so fast because we'd get these receivership deals and manage them for 3 months, and then they'd go, and we were turning, and we said, if we want to stay in this business and not lose our hair,
Right.
we probably need a portion of our portfolio to be stabilized institutional clients. And we just said it and it happened. Over the next 6 months, we started acquiring more stabilized institutional clients. And a lot of times they would come in, buy a building from a receiver,
Right.
and then say, hey, we like the way you're managing it and stay. But it is converting. Literally, I can say just internally, our
Right.
portfolio went from 100% receivership type properties to 50 or 60% just in the last 6 to 9 months.
Right. A great theme for the morning. These folks looked at the industry. Development companies said, I need to change into more asset management. They realized the trend was CMBS and became servicers. They became property managers. They started looking at different types of transactions. So I think these are all opportunities. These are all great lessons for all of us to learn that there still is activity, that people are doing deals, that money's to be made, but you have to approach it recognizing it's a different day. And you can't wait around for the same dynamics that were there 5 years ago. I think it's a huge factor. When you do a build-to-suit, Doug, that's a lot of economic activity. Those things can be, what, $20 million, $30 million? Mm-hmm. There's a lot of people that it takes to go through a transaction like that.
Well, and I don't think we should underemphasize the psychological boom it has for a community. I mean, it seems silly to talk about, but the fact that a new building's going up gives people a little bit of hope to say, you know what, things are turning around. We can see a new day, especially in Las Vegas, where it's been a pretty good market for 20, 25 years, where I was used to, when I started out in the business, I was on the construction side, and I traveled around the country doing buildings for people, build-to-suits for the most part. And I came to Las Vegas in the mid-'90s, and I was a little surprised on the pick up the phone because somebody's calling you and they have a deal, rather than going out and hustling and go get the deal yourself. So I think people, I'm not saying they became complacent, but
right.
They became complacent.
I remember those days.
Yeah, we all do.
Yeah, you're just catching deals. And I think it's made people appreciate what they had before, right. The fact that it can come back, but the psychological boom of having something go out of the ground is huge.
Right.
And for our subcontractor pool and our general contractor who we work with all the time, it's nice to be able to say, I'm working on this, this, and this, and our construction company's fairly busy and we're busy. But you're right, that the fact that you're going to employ a design team and geotechnical guys who go out there and do the work, and not to mention the physical work of going out there and actually doing the grading and pouring the slabs and doing things you do on the construction site, it could be several hundred jobs for the Shuffle Master project. It's significant. And again, people see that on the freeway, the walls go up, and they say, wow, something's happening.
I agree. And not only something as dramatic as a build-to-suit coming out of the ground, the amount of tenant improvements that are going on. Think about the large lease transaction you did from a brokerage standpoint, but that you're involved from property management and buildings. There is a lot of TI work that's going on right now. It's not obviously what it used to be in terms of buildings coming out of the ground and TIs and large casinos and things like that, but I think there's a lot more TI work happening than people know, and that's a positive sign for a lot of people. You're involved in a lot of these right now.
We are, and they're not small either.
Right.
We just finished managing a $700,000 TI contract. There will be a much larger TI contract than that for that
large
client
deal.
that we just talked about, and
right.
Those are pretty good sized deals, and they keep a surprising number of contractors busy.
Yeah, I think that's important. You know, when you talk about brokerage and different things going on, talk a little bit about the differences within the disciplines. Retail on the strip is different than retail in a strip center scenario, and we have to be aware of that because we read somewhere that the average rental rate for retail space is X. Well, if you're blending the retail rate from the Forum Shops with a strip center at the corner of 3rd and 3rd, it's a completely different dynamic. Talk about retail a little bit from what you're seeing, just in general terms. Is retail coming around, or what are your thoughts on this?
I think there's some good signs of retail coming around. It speaks to, I think, consumer confidence, and folks have a little bit more money to spend than they did just in the last 3 years. Forget everything before that, forget the boom. But you're right, you cannot generalize retail rents or any rents for that matter. You've got different types of retail categories. There's little strip centers that are mid-block that have your tax consultant, your hair and nail lady, your florist, and maybe some other use. And then you have a grocery anchored center that services a neighborhood. But retail developers and users look at different things than, let's say, an office developer or an office user. They're looking at traffic counts, they're looking at rooftops in the area, they're looking at tenant synergy, whereas an office user might look at connectability, which you talked about, to a building. They're looking at more of a lifestyle because they're housing people, they're not necessarily using the space to drive sales.
Yeah. If I can go on that, just on retail in general, it seems like we're going through a transition, not just because of the economic issues we've had in the last 5 years, but in Reno in particular, the 300,000 foot lease we just signed with a company called BizChair in Reno,